Welcome to an episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Andrew Brewer. He is a commercial real estate operator and developer who founded his investment firm in 2017. Since then, he has served as the lead sponsor and developer on multiple ground-up development projects and land subdivision projects comprised of hundreds of residential units, collectively valued at over $160 million. Thank you so much for coming on the show today, Andrew.
Thanks so much for having me.
So can you give us a little background? Because everybody has a different background before getting into real estate, but yours is pretty unique. You were in a couple different parts of being an employee, and then in some other ones that were kind of complementary to what you do now. So can you give us a breakdown of yourself, both personally and professionally, prior to getting in investing in real estate?
My first job is in high school, I started working at a butcher shop. And so I became a butcher, and I did that through high school and college. So for 8 years, that was my job. And then after college, I got a job as a stationary engineer. And no, that's not engineering new kinds of paper. It's actually stationary in the sense that you're not moving, right? It's a stationary object. And that is in opposition to what they call marine engineering, which is maintaining large boats, essentially. So that could be military vessels or freighters or things like that. So a stationary engineer does the same thing a marine engineer does, but in a stationary facility. So that would be a large building. So think, high rises, hospitals, things of that nature. So I did that for about 4 years. And stationary engineering is really, it's kind of like a combination of building maintenance and asset management. You're managing all of the major mechanical systems within a large building. And these large buildings, if it's a high rise or something, typically have different systems than your basic residential building. You'll have like a generator that can power the entire building that you have to maintain. You'll have maybe a chiller or a cooling tower, because if you look at generally like an apartment building, you'll see a whole bunch of condensing units outside around the building, because each unit has their own condenser. In a very large building where you don't have a lot of roof space or anything, you have to have one central building system, and that would generally be on the roof, but it's like a massive system. So it's dealing with a lot of that kind of stuff, and then managing all the different vendors that come in, plumbers, electricians, diesel mechanics, things of that nature. So I did that for about 4 years, and that was very complementary to what I'm doing now. At the same time I was working in that job, I was investing in real estate on the side, just myself, small single families, small multifamilies. I was working in California, so I started investing out of state because I couldn't afford to buy in California. So I was building a portfolio in Kansas City at the same time. And Ghana got to a point with my job where, some projects were wrapping up. And there was kind of a natural exit point for me. So I decided to take what I had learned from investing in real estate with my own money by myself, and then also the skills that I had learned from my W-2 position, and just put those together and start my real estate development company. So that's kind of how I got into real estate there.
Why did you choose real estate as an investment vehicle, even when you were working and you were investing into single family rentals?
I like the fact that there's income that can be generated from investing in real estate. For some people, if you're investing passively, there's, potentially cash flow, whether that's investing, a chunk of money into like a real estate syndication or a REIT or something like that, or whether it's, just buying a property by yourself, like a house, and renting it out. There's an income component that isn't dipping into, the equity that you own. And I like that in opposition to things like stocks, where there are some dividend stocks, but for the most part, your money is made through the appreciation of the stocks. And if you're cashing out, something to live on, you're generally eating away at your principal. There's like the 4% rule, I think, with stocks, where you liquidate 4% per year. But if the market is appreciating at 7 or 8% per year, then you're not really losing your principal. But there's very little of actual like cash flow or things that you can live off. I also like the fact that there can be an active and a passive component in real estate. So with stocks, I mean, you own some part of a company, but you're not involved in the day to day. You're not managing stuff. You don't really have the ability to just get a salary also from your ownership in the stocks, unless you go and apply to work at that company. And in that case, you just have a job there. They're not saying we're going to give you a job because you're a shareholder. They're just saying you just have a job. And what I'm able to do in real estate is, I can invest passively into some deals, or I can buy more passive investments, or I could take a more active role. And I have the experience to be able to take an active role. And that's a lot of what I do now. I have some passive investments, but I do enjoy the active aspect of it. So my development deals that I do, I'm the developer in those. I'm generally the lead sponsor in those deals. So I also have the ability to be active, to have more control over the deals. And I like that. There's just a lot of flexibility. There's a lot of different ways to do it. So that's been the appeal for me.
Yeah, that makes perfect sense. The passive and the active side of it makes sense, and I think it's great where if you're not a professional or really experienced in an area to be active, you can put your money and get exposure to it in the passive realm. For instance, I'm not a developer, so I would put my money with a developer on a passive side, whereas I would do something a little bit more active where it comes to what we really focus on, which is like value add, different type properties. One thing when I was preparing for this episode, mentioned in your background that you were involved with construction defect litigation. Can you explain a little bit about that and maybe some lessons that you learned from doing that you've brought into what you're doing now?
Yeah, so construction defect litigation is essentially lawsuits against builders and developers who develop and construct properties, but do so very poorly. So, you know, the same as like if you go to a store and you buy some products that, should last for a while, the company will generally give you a warranty for like a year or something. Um, Builders and developers are not giving out a warranty necessarily, but there are generally accepted timelines for, how long things should last. So, you may not have a warranty on the pipes in your house. But, I think everybody would probably agree that, if you're getting a lot of leaks in your walls within a couple years of your house being built, that's, something's probably wrong there, or something was done incorrectly in construction that's leading to what most people would agree is a premature failure. So there's generally a 10-year window to bring a construction defect lawsuit against a builder. It has to be proven that it is, in fact, construction defect, and it's not just, some issue with the materials or something. Because it could be like, hey, you just got a faulty batch of pipes and the plumber had no idea, and it's not really their fault. But you could also say like, okay, well, did the plumbers, ream the pipes out? Did they install them correctly? So it's a large process that you go through to determine whether it is construction defect or not. Generally, what will happen is there's law firms that target construction defect lawsuits. So the group that we worked with was based out of Los Angeles. They're one of, I think, the leading firms for construction defect nationwide. And what they really do is they go around to different buildings and just kind of ask questions. They're like, hey, how is your maintenance? Like, do you feel like you're having a lot of repairs? And they'll kind of look into it and see if they can identify a pattern with the repair logs and say like, oh, you guys are having to do, a lot more plumbing repairs than would otherwise be necessary. Or, oh, like really your elevator failed, after 3 years and you had to replace it. That seems very strange. Or, you're having issues with, your electrical systems or whatever it is. And they'll look for those patterns. And if they feel like there's a potential for a case, they'll generally approach the building owner, whether that's an individual or an HOA or whoever the owner or owner group is, and they'll basically say, "Look, we've reviewed all of your records. We believe that there may be a case for construction defect litigation. we would like the opportunity to represent you in that. They generally do it on commission. So they'll front all of the costs for the litigation. Like they'll pay for all the experts, they'll pay for the tests. They may even pay for repairs in the meantime, in between when the contract is signed and when the case is won. And then they'll get a reimbursement for all of the fees that they paid up front. And they'll generally take, 30 to 40% of the proceeds of the lawsuit as their payout. So it's very attractive for buildings to do that, because if there's not a case and they lose, like, the building doesn't care. They've probably gotten a lot of repairs done on the law firm's dime over the 2, 3, or 4 years that it would take to do the lawsuit. It didn't cost them anything out of pocket. Like, they only have upside. So that's generally how that works. And then the law firm brings in their own experts. They will spend 2 to 3 years building a case, documenting everything, testing things, and then they'll generally go to, they'll file a lawsuit. Oftentimes, the developer or the builder will have some kind of insurance, so they're basically settling through insurance. But that's kind of how it is. And so for me, I was hired as a stationary engineer because the facility I was working with was gearing up to file a lawsuit, and they needed more help. Because there's a lot of additional work that the engineering team or the facilities maintenance team has to do in order to work with the law firm. So you need more staff. So I was hired at the very beginning of that, once they knew that, like, hey, there is going to be a case here. And so I worked at that facility for about 4 years. 2 to 3 years of that was building a case. The last year was bringing that case, and then once the case was settled and the payout came, the proceeds were used to do reconstruction on the building to fix all of those problems, because that's why we got the payout. They give you the payout so you can fix all the problems. So for us, that included redoing all of the window seals, redoing a lot of the roofing, full repipe of the entire building, a lot of stuff like that. So that's kind of it in a nutshell. But learned a lot from it. As you can probably imagine, there's a lot of ways that contractors can cut corners, and that's really part of the reason why I then went into development. Having seen all of the problems that can come up, down the line from faulty construction, I look at buying a value add building now, and I'm kind of like, ooh, I don't know what's in the walls here. I don't know if they installed this stuff correctly. Whereas if I'm developing a property, I can go look at it, and I can see the walls while they're still open before they sheetrock it up, and I can look at it and say, nah, you didn't do that correctly. You need to rip that out and redo it, because I'm not about to get hit with a lawsuit 9.5 years down the line because you didn't install stuff correctly.
Interesting. Yeah, that's quite the unique kind of experience that you have there to bring to what you're doing now. So for right now, like, what are you doing? What's your overview of your company now? What's your current investment strategy and criteria? What is your company working on?
So right now we do development deals. So mostly focused on residential type assets. So we're developing a couple of single family home subdivisions. We're developing an apartment community, a couple of townhome communities, manufactured home park, and we're expanding an RV park. We didn't develop it from scratch, but we're doubling the size of it. So, and all of those have to do with some kind of residential housing. So that's kind of where we focus right now. The market's in a bit of a weird spot, so we've been very selective with projects lately. We haven't started many new projects recently, just not wanting to get overexposed when everybody's a little bit shaky on development. But we're continuing to work with the projects that we already have, and that's moving along. We also buy RV parks and mobile home parks just to hold those and operate those as assets. With development, depending how you structure the deal, there's generally not a lot of cash flow, even for the developer. And the way I do a lot of my deals, I don't take incremental development fees up front. I generally take my compensation on the back end as a percentage of the profit split. So I'm paid based on performance. If I do a good job and the projects work out the way I think that they will, I get compensated very well. But if not, then, I'm making sure that the debt, the investors, any preferred returns are getting paid back first before I'm taking really any money out of the deal. I try to make sure that I'm putting my money where my mouth is and not just saying like, oh, I'm going to, take some multi-$100,000 development fee, regardless of whether I do my job well or not. So, right now I still like development, but want to be very selective in the deals that we're taking on. So that's what we're doing. We're continuing to work on the deals we have, and we're, buying manufactured home and RV parks in the meantime also, because we see some opportunity there.
Yeah, that's great. Yeah, the alignment of interest is one of the most important things, and the GPLP type relationship that I have found over the years. And so it's great that you kind of see that as well. For people that really haven't get involved with ground up development before, can you kind of break down the different steps and phases involved in a ground up development process?
Yeah, so with ground up development, it's going to vary a little bit based on the municipality that you're in or the asset type that you're working with. But for the most part, you have land. It generally starts off as what they would term raw land, which means that there's nothing on it and it's not really zoned for anything. It's generally raw land would be land that is not in a city or it's agricultural land generally, so it's being used to graze cattle or grow crops or something like that. And at least here in Texas, agriculturally zoned land typically has a tax exemption on top of it because agricultural use is not doesn't generally produce a lot of money. So that would be like very, very basic. So you find a piece of land. If it's at the very beginning, it would be raw land. And then from there, you would go in and try to get that land zoned to, whatever it is that you're trying to build. So the city or municipality, or if it's a city, there will be some kind of zoning that you have to adhere to. If you're not in a city, generally there's not any zoning. If you're just in a county, you can generally do what you like as long as you adhere to building codes and everything. But most of the development that you're going to do, unless you're just doing houses or something, is probably going to be in a city, and there will be different zoning districts. There will be residential zoning, commercial zoning, industrial zoning, multifamily zoning, or some kind of mixed use zoning where, they could potentially approve, some kind of commercial or maybe some kind of transitionary residential, something like townhomes or something. And then the zoning codes that you have, that'll kind of outline how many units you can put per acre, what kind of products you can put, things like that. So you'll get your zoning. Once you have your zoning, then you do generally a preliminary plat. So you have to plat your property, and the plat is the document that you get approved through the city that says, this is now what I'm going to build, and this is what my property will look like. I'll have, streets over here. I'll have this many units. They're going to be on this part of the property. I'm going to have my detention pond or, whatever it is over here. I'm going to have my clubhouse over here. The plat shows, where all the buildings are going to go, how big the footprint of those buildings are going to be, where the roads are going to be, where the utilities are going to be, like that kind of stuff. So you'll get your preliminary plat approved. Generally from there, you'll get your civil construction documents, and that'll be like the exact specifics of what's going to go where and how it's going to be constructed. So it'll be like, I'm gonna run the utilities through the middle of the street. It's gonna be in a 24-inch trench. It's gonna be 6-inch pipe. It's gonna connect to the city line over here. Like all those really specific details are going to be in your civil construction plans. Get those approved. And once your preliminary plat and your construction plans and your zoning and all of that is done, you'll generally get your final plat approved through the city. And once you have that, you can start constructing at least the infrastructure, as they call it, on the project. So that's like roads and utilities and things like that. And then quite separately, you have your building plans. And the building plans are just, it's like a house, right? It's your architectural drawings, your mechanical, electrical, and plumbing, your structural, all of that goes together in one plan set. And you submit that to the city separately and get those approvals. And once those are approved, then you can actually build those buildings on site. And once you're done with that, you get your CO or your certificate of occupancy. And then you can either sell the buildings or rent them or whatever you're going to do. And that's, kind of a little 5-minute breakdown of generally the process. It's a little bit different depending on the asset class or where you're at, but for the most part, those are the steps that you take.
Yeah, Andrew, that's a lot of great information. Thank you so much for breaking it down there. One question I have obviously is like you have a specialty in looking at vacant land and figuring out kind of what its highest and best use are. And I have a partner who's a single family developer, and he'll show me a piece of land, and I see one thing, and he's telling me just how you're breaking it down. This is where the road's going to go. This is how many property, how many townhouses they're putting up here, everything like this. So when you're looking at a vacant piece of land, I mean, how do you, without going through extensive underwriting, I guess, I mean, how do you put a value on it and seeing kind of like how I can find, maximize it for highest and best use for myself, my investors, and also, I mean, you're pretty much getting in partnership really with the community in some sense, because you want something to help the community so everything gets signed off, but also, so I mean, it's a benefit too. So there's a lot of moving parts there. You know what I mean?
Yeah. Some of the biggest factors, for me are there's some very basic characteristics of the land itself that you want to look at. Things like, is it in a floodplain? Is there some endangered species that lives on the land? Things like that, which will kind of automatically restrict you in some ways. There's other, there's, I would put those kinds of things in one category. Another category of things to look at are what are the actual physical characteristics of the land. So is it very hilly, like a lot of topography changes or elevation changes? I mean, it's far more expensive to develop land that's like on a hill, right? You have to do a lot more structural engineering. At least here in Texas, trees are a big thing. So do you have any very large trees? Because some municipalities will not let you cut down what they term to be heritage trees or trees over a certain size. So you got to look at things like that. Is there a lot of rock in that area? If the entire property, has limestone, for instance, that's like, a foot below the surface, but then you have to, sink your utilities 3 feet below the surface. I mean, you're going to have to go in there with dynamite and blast out a whole bunch of rock, which is very, very expensive. And we have, properties that are just completely limestone in the Texas Hill Country. So there's those physical characteristics you have to look at also. You also have to look at the presence of utilities. Do you have access to water? Do you have access to sewer? Do you have access to electric? And not only looking at, are those utilities running near your property, but are you allowed to tap into them? Because there may be a water line on the road outside your property, but if that's a city water line and your property hasn't been annexed into the city, well, you can't access that water unless you annex into the city. And the city might not let you annex, or if they do let you annex, they might put a bunch of restrictions on you that'll kill your project. So you also have to look at presence of utilities. Presence of utilities, in my experience, is the number one predictor of value. Like if you have access to water and sewer and electric, your property is going to be worth like 10 times what it is if you don't have access to any of that. So that's another key thing. The other thing that you have to look at is what does the city want you to do there? Because every city is going to have a future land use plan. Let's plan 20 to 30 years out in the future. And they're going to say, well, on this property that you're looking at, we want you to put this type of thing. Like we want you to put houses here, or we want you to put a commercial building here, or we want you to keep this as agricultural land. And I don't go to war with the city. I always just kind of do what they want. So if I'm saying like, hey, I'm a townhome developer, I want to build townhomes here. but I go look at the city's future land use plan and they say, well, we envision this area being an industrial part of town and we want warehouses there. I'm going to say, oh, well, I'm not going to do that then, because the chances are slim to none that I'm going to get the city to change their mind and approve my townhomes. So there's all of those kinds of things that you want to look at to make sure that the project is going to be viable. And that's, like you said, before even doing any underwriting to see if you can actually, if what you wanted to do and everything worked out and the city liked it and you had utilities and everything. I mean, you still don't know if it's going to be, viable from a cost perspective. Can I afford to, or, can I afford to sell or rent these property or, these buildings for the cost it's going to take me to build them? Because some markets are cheaper to construct in than others. Some, have more, have a higher end value depending on where you're at. But you're getting into the underwriting when you start looking at that kind of stuff. But yeah, I mean, there's a lot that goes into it. Like for me, it's kind of second nature now, but for a lot of people, it's probably quite an exercise in trying to, remember all of the things to look at.
Yeah, no, it's definitely just figuring out if a property underwriting a potential vacant lot is, a whole thing from let alone building it too. You know what I mean? Um, but let's talk about for some passive investors that might be interested in investing into a development deal. What are some like key factors that they should know before investing in the ground development that you would say if you were on the passive investing side into someone else's deal?
Um, the number one thing that I would look at is the viability of the project and um, how much work has been done to make sure that the project is viable and how much risk has been taken out of the deal. So I see a lot of people pitching development deals where, really they haven't done much beyond found a piece of land that they think is a good price. But development deals can go wrong for so many different reasons, and they could not be approved for any number of things. And so I like to see a backup plan, but I also want to know that the developer has at least gone to the city, talked to somebody, got an idea for, what's going on in the area and whether the thing that they want to build is going to be appropriate for that area and whether the city wants to see it or not. Because, like I'll give a couple examples. I saw a project in, I think it was in Florida that somebody was pitching, and they had they had found this piece of land, and they had said, invest all of this money. We found this piece of land. This is what it's going to cost, and if we achieve what we want, you're going to get a whatever 500x on your money. It's going to be all great. But if we can't achieve that, it's going to be like a 200x or whatever. We're going to do this other project type, and if we can't do that, we're going to do this other project type. And it was basically like the best case scenario was they were going to be able to build a skyscraper, and you would and investing in this project would be like investing in Amazon in 1996, and it was just going to be the greatest thing in the world. But if it didn't work out, then you were basically just going to lose all of your money. And I'm looking at it and I'm kind of like, you haven't talked to the city or anybody about this at all. Like you just, made up a bunch of stuff and you said, well, shit, I could build a skyscraper on it. And it's like, but probably that's not going to happen, So what is the most realistic thing that you're probably going to do here and underwrite to that? Whenever I do my deals, I develop the entire business plan and I run it by the city. And, and even if I run it by the city, there's not a guarantee that they're going to approve it, but I at least want to know that they're aware of what I'm doing and they're not just saying nope, no way. I try to get some kind of hey, if I did this, if I built this many units of this product type, is that something that, the city would like to see in this area that you could see yourself, putting your stamp of approval on? And if they're like, yeah, if it was well designed and, took these things into consideration, we'd do it. I'm like, all right, that's been fairly de-risked now. Or I've seen, another project I saw was somebody, they had bought this vacant lot and they were like, I'm going to build a 6-story, mixed use, building. And I looked at where it was. I think this was in Georgia. And I'm like, this is a vacant lot in the middle of a residential neighborhood, most of the houses of which were built in the 60s. And it's kind of, a little dumpy, a little rundown. It wasn't like a complete ghetto, but it wasn't like a nice neighborhood. And I'm like, well, that's just not going to fit in this neighborhood. You're going to have all these single family homes and then like some 6-story building like out of the middle of nowhere. Like it just doesn't fit. I don't realistically see it being approved. I don't realistically see anyone else coming in to build this because, I mean, who's going to rent there, or who's going to buy this?
Exactly.
So that's the number one thing for me is project viability. Also, the sponsor's experience. You at least want somebody on the team that knows what they're doing, and you want somebody that's local also. Because that's another thing that I've seen people kind of, especially people from California, and I'm originally from California and I moved to Texas, but I've seen other Californians that have moved to places in Texas with a lot of money burning a hole in their pocket, and they go and buy some piece of land and like walk into the city meetings thinking, well, I'm some hot shot. I got all this money. I'm going to develop this thing. And the people at the city are just straight up like, no, we don't like you. You're not from around here and we don't like your attitude. So we're just not going to approve your project no matter what you do. And they just like completely lose their shirts on it. So I want to see somebody that's local to the market. They don't have to necessarily know exactly what they're doing. But they need to be the person going to the meetings where they can say, hey, I'm a part of this community. I live here, or I've lived here. Maybe I have a business here, or I have some investment in this community. People with the city and the planning department are going to be so much more likely to talk to that person or approve that project if they feel like the developer has some kind of interest vested in the community beyond lining their own pockets. So active presence in the market, somebody that knows what they're doing. Could be the same person, could be two different people. Those are the two key things I look for on the development team. And then project viability, and also making sure the project is well capitalized. That's the other thing. Those would be like the three things because, markets change, right? Things go up, things go down. It's a tough market out there for development right now. And if you're not prepared to hold your project maybe a little bit longer, you could lose all your money or all your investors' money. So just making sure that that you have not undercapitalized the deal, that there's some reserves, there's some interest reserves, you've got the ability to extend your loan or maybe to refinance. There's not just like, hey, if I don't get it done exactly on the timeline that's on the OM, everyone loses their money. Like that's not a good position to be in. Yeah. You want to be able to say, this is our projection. We think we're going to get it done in this timeline. If for some reason we need to hold the property another year or two, we have the ability to do that, or we have a plan that will allow us to do that. So those would be my top three for passive investor.
Yeah. That's a lot of great information. One thing you said about working with sponsors that have local knowledge, that's one thing when looking at a deal passively, or even if you're going to get involved as a co-GP in something, or if I was looking for property managers, when you're speaking to them and when they start throwing around that, because everybody does their underwriting, like you said, like the people in Florida with the skyscraper, they do some sort of underwriting, right? But when people have like done their research and they're like, oh, we've gone to town hall, we've gone to these meetings, we've spoken to people on zone, all this in-depth, I would say, more in-depth than usual due diligence this is where it's like where stuff starts lining up because these people know it intimately inside and out. Or I'm a property manager in just this one town and these like 4 zip codes, and this is what I've been doing for 20 years. Another thing, like, local, they specialize in one thing. It's worked for them for many years and they have all the connections that go with it and all the contacts. And that's a lot of great information that people can use, I think, when investing in development deals, and I think in kind of any type of real estate deal, if they're active or passive when working with other people.
Yeah, definitely. Local knowledge, no matter what, is very, very important.
As we're kind of wrapping up here, when I've looked at development deals, and I've passively invested in some before, how does that kind of the compensation, is it much different than a typical value add? I know this is really deal specific, but you guys are obviously putting a lot more time into these deals. There's a lot more risk. You're putting a lot more on the line. It's much different than if you're buying an apartment complex, 100 units, it's 90% occupied. We're going down to 80% occupied. And we're doing 2 units a month renovating, or 3 units a month. A lot less risk there. Once you have the contractors in place, there's not that, not as much time intensive, right? With you, I mean, you went through the whole process, which is daunting, you know what I mean, to say at least, for doing it. So how has that compensation changed? Are you getting usually a higher share? And like I said, it's all deal specific, not going to hold you to it. Just how a typical like business plan compensation works.
It's actually fairly similar, at least in the deals I've done, to like multifamily or syndications like that. And that may be because I initially kind of looked into multifamily syndication before I really settled on development, and found that as my niche. But it's fairly similar. I would say some key differences is that you don't have an asset management fee. You would have a development fee instead. Generally, there's not an acquisition fee, or as large of an acquisition fee. Now I know that, I mean, some people make the argument that there shouldn't be acquisition fees in multifamily either. And I, having seen some people be exposed as bad actors in the space over the last couple of years, I'm more inclined to agree with that. I have sometimes taken acquisition fees. Generally, it's quite nominal though. It might be 10,000, 20,000, something like that, like pretty small, and that's more and also a reimbursement of expenses up front. And for me, that's more like okay, if I just spent 6 to 8 months putting this deal together, 10 to 20,000 is probably, I would think, appropriate for that amount of work, plus all of the expenses that I paid out of pocket. Which for me, I mean, I've had deals where I've spent $120,000 out of my own pocket doing preliminary engineering and earnest money and fees, third party studies, all that kind of stuff. Um, Honestly, I haven't done many deals with development fees. I know some people do. I don't. Maybe that's just more, me being scared. I'm not sure, but I never want to be in a position where a deal is not working out like I wanted it to. And then there's a potential for an investor to come to me and say, hey, this deal didn't work out. I've lost money, but I also know that you made money on this development fee, and that doesn't sit right with me. If I was a passive investor, and I am a passive investor in some deals, that would be my feedback, is like, you should not be making money if I am losing money. So I just don't ever want to put myself in a position where that conversation could be had. I like to consider my money earned once it's earned. So once it's in my pocket, I don't want it to come back out, right? I want to say, no, I earned this money, and you can't say that I didn't, because I did my job well. And, this came as a result of that. So that's maybe just more me personally, not taking development fees, even though sometimes I write them into the deal. But then it would be like, okay, but I'll get paid this fee at the end of the deal before a profit split, for instance. Like, we're going to return all the investor capital, and then I will get my development fee, and then there will be a profit split, something like that. But generally, for me, I take my money at the end, and I do try to structure it so that I get a higher split of the potential profit. I may give a higher preferred return and a lower split of the profit, because I do work hard, and I'm also taking the risk that, hey, I'm going to work for 2-3 years for nothing. I want to make sure that there's upside for me at the end. Like, if I'm going to take a low split of the profit, I may as well take money along the way if the upside isn't there for me. It's risk reward, right? If my risk is higher, I want my reward to be higher. And if I've structured the deal so that the risk to the investors is lower, then the return would be lower. But it's pretty similar to anything else. There's a potential for an acquisition fee, maybe not. There would be a development fee. and there would be a profit split at the end. That's typically how the compensation works. And that's for the developer. Now, if you're also the GC or something, there would be GC fees or architect fees or something like that. I'm not a GC, so I don't get a GC fee. I'm not the architect. I don't get the architect fee. I'm just a developer. So that's how I see compensation typically done, and how I like to do it, because it's very important to me to make sure that investors are taken care of. And if for some reason the deal isn't going the way it should, I just don't want anyone to ever think that I was profiting off of somebody else, losing money, or that I'm getting paid regardless. Like, I don't want to have that conversation. If there's a deal that didn't work out, I at least want to be able to go to the investors and say, hey, like, this deal didn't work out for, whatever reason. Hopefully it's not because of me. I've never had a deal where that's the case. But, at least I can say, look, I worked on this deal. I did everything the best that I could. I made no money on it. The deal lost money. That's unfortunate, but you can at least know that not a cent went into my pocket. I think that's an easier conversation to have.
Yeah, that makes perfect sense. Yeah, I mean, if you're the GP on a deal and getting your upfront costs covered and some of your time covered that went into finding the deal and putting it together, I think, is a reasonable expectation. You just have some people that obviously they, getting 1.5% as an acquisition fee or 2% is much different than someone trying to get 5%. You know what I mean? Or some sort of kind of crazy number. And that's where the bad name comes. You know what I mean? Someone that's like, well, I underwrote 150 deals and we did this many offers and we did this and we spent all this hours. That's why I'm taking a 2% fee. It's different than someone's like, all right, well, we looked at 10 deals or 20 deals and, 5% on every deal, no matter how easy or hard it is to find it, is a different model that I don't think is a long-term solution for building a relationship with investors. But Andrew, a lot of great information. Thank you so much for diving deep into ground up construction with us and the listeners. How can our listeners learn more about you and your business?
Yeah, you can visit my website. It's irongallinvestments.com. That's IRONGALL investments.com. You can also just shoot me a direct email. My email is just andrew@irongallinvestments.com. You can find me on Facebook and LinkedIn. Those are the two platforms I'm the most active on. More active on Facebook, though. But yeah, just hit me up. I'm always happy to chat development or speak to people that are interested in getting into it or investing in it or whatever. Just love meeting new people, making new connections. So yeah, just hit me up or visit my website.
Thank you so much, Andrew, for being on today, and looking forward to connecting with you here in the near future.
Thanks so much. I appreciate you having me on.